You spend decades building a modest nest egg for your later years. But as you calculate your retirement income, you realize your savings might actually disqualify you from crucial state support. Here at ProTax Accountant, one of the most common questions we get from clients approaching state pension age is exactly how their hard-earned savings will impact their eligibility for pension credit, especially once those savings cross the £10,000 mark. The confusion usually stems from the rules attached to working age benefits. People assume the strict £16,000 hard cap used for universal credit applies to retirement benefits as well. To clear this up, we need to look at what pension credit actually does. It is a government top-up designed to guarantee a minimum weekly income of £227.10 for single retirees, or £346.60 for couples. The danger is a persistent myth. The belief that holding exactly £10,001 in savings results in instant and total disqualification from this top-up. That belief is entirely false. Unlike universal credit, pension credit has absolutely no upper capital limit. You can hold £50,000, £80,000, or even £100,000 in savings and still potentially qualify. Instead of a cliff edge cutoff, the Department for Work and Pensions uses a mathematical taper system that activates only after your savings cross that initial threshold. Believing the cliff edge myth causes eligible UK retirees to self-disqualify, leaving thousands of pounds in financial support unclaimed every single year. To understand the math, we look at the lower capital disregard. As you can see in this diagram, the DWP completely ignores the first £10,000 of your savings. It does not factor into your pension credit calculation at all. The complexity begins the moment your savings exceed that floor. Any capital above £10,000 will trigger a mechanism called tariff income. This is a specific calculation where the government treats your excess savings as if they are generating a weekly cash return. The exact formula is strict. For every £500, or any part of £500, held over the limit, the DWP deducts £1 from your weekly pension credit award. Let's run a practical case study. We have a client who holds exactly £11,000 in savings. Step 1 is to subtract the £10,000 disregard. This isolates the remaining £1,000, which is classified as excess capital. Step 2 divides that £1,000 excess by the £500 rule. This results in 2 chunks of £500, giving our client a total weekly deduction of exactly £2 from their pension credit. For financially savvy viewers, £1 a week is £52 a year. Earning £52 on £500 equates to a 10.4% deemed annual return. The system assumes a high yield to encourage retirees to utilize their own wealth for daily living. Because this relies on a gradual taper rather than a hard cutoff, individuals with higher living costs or severe disabilities can hold significant savings and still easily remain within the pension credit system. The math requires us to know exactly what the government counts as capital. The DWP's definition goes far beyond the cash sitting in your current account. Standard countable assets include individual savings accounts, premium bonds, stocks, shares, and the value of any secondary properties you own. There is, however, one major exemption in the rulebook. The value of the home you currently live in is entirely disregarded. Consider a pensioner living in a fully paid-off house worth £500,000. As long as their liquid cash remains low, they are entitled to receive the maximum pension credit payout. Their property wealth is protected from the calculation. Or take a retiring sole trader, like a plumber, who keeps £15,000 from the sale of their work van. Taking the resulting £10 weekly tariff hit on their pension credit is often a much smarter financial move than rushing to spend down that cash just to avoid the deduction. Understanding exactly which assets the DWP disregards allows you to legally structure your wealth without accidentally triggering tariff income deductions. When people see how tariff income works, they're often tempted to give away cash to drop below the £10,000 threshold. Doing this triggers a strict legal trap known as deprivation of capital, which results in notional capital. This means the government treats you as if you still own the assets you deliberately disposed of. If you gift £20,000 to your children specifically to qualify for benefits, the DWP will assess your claim as if that money is still sitting directly in your bank account. You do have safe harbors. Spending your money to pay off legitimate existing debts or on reasonable daily living expenses does not count as deprivation. You also need to proactively monitor your balances. The DWP has phased out assessed income periods. Without them, you must now notify the pension service whenever your capital crosses a new £500 boundary. Trying to outsmart the DWP usually results in losing access to your cash, while still suffering the exact same benefit reduction. Strict compliance is the only viable strategy. This brings us to the return on investment. If tariff income reduces your pension credit top-up to something small, like £5 a week, is the administrative hassle of reporting to the DWP actually worth your time? It is, because pension credit serves as a gateway benefit. This means your eligibility for the top-up serves as the primary qualifier for other separate support schemes. Securing an award for even a few pounds a week automatically qualifies you for a range of secondary support, including full council tax reductions, the winter fuel payment, and free NHS dental care. That seemingly trivial £5 weekly top-up actually yields thousands of pounds in indirect yearly savings by eliminating major household bills. Some people try to keep their income low by deferring their state pension, but the DWP counts the deferred amount as notional income anyway. There is no advantage to waiting. Claiming pension credit is a strategic financial imperative. It lowers your total cost of living, regardless of how heavily tapered the actual weekly cash payout becomes. To protect your retirement, follow 3 rules. Never self-disqualify just because your savings exceed £10,000. Never attempt to illegally hide assets. And never ignore the financial value of gateway benefits. Please note, this video is for informational purposes only and does not constitute formal financial advice, as individual circumstances vary. If you are managing a business exit, navigating joint estate planning, or need to properly structure your assets before you retire, you need bespoke professional advice. Reach out to our team at Pro Tax Accountant. Call or email us today, and subscribe to our channel for more expert UK tax guidance.